Welcome to my channel. I'm Scott. In this video, I'm going to walk you through the process of valuing Hilton stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at $204 a share, and they have 250 million shares outstanding. Hilton manages and franchises hotels, resorts, and timeshare properties. It has over 7,500 properties with 1.2 million rooms in 118 countries. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Almost no free cash flow in 2021. It jumped way up to 1.6 billion in 2022. Grew to 1.7 billion in 2023, then over 1.7 billion in the trailing 12 months. Pretty good margins. They converted 18% of their revenue to free cash flow, 17% on the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that triples from 400 million to 1.2 billion. Revenue is the sales for the company, and that goes up from 6 billion to 10.5 billion. A nice steady growth each year. Their revenue per share is $42. The way you calculate that, it's revenue over shares outstanding. And they pay a really low dividend, 0.29%. It only cost them $148 million. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 42 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $37 billion. We divide that by 250 million shares, and we get a calculated stock price of 148. They're trading at 204, so they're trading at a 38% premium. It's a sell according to the model. There are 12 companies in the same industry as Hilton, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 200 million in CapEx. The only one who spends more is Marriott. We can't look at their debt to equity ratio. They have negative equity. When a company has negative equity, its liabilities are higher than its assets. They pay a small dividend, the smallest on this list of the companies who pay a dividend. They generate a lot of free cash flow, 1.7 billion, second to Marriott. Only Marriott is bigger in terms of market cap. We can't look at that price to book, negative equity. They have the worst PE, 42. They're trading at 42 times earnings. They're trading at 29 times free cash flow. The only one worse is Choice. They're trading at 5 times revenue, the worst on this list. They generate $10.5 billion of revenue, but the lowest relative to their market cap. And they're not really growing much anymore. Their 5-year annual revenue growth rate is only 3%. If you put $10,000 into this company 10 years ago, you'd be really happy at $48,000 today. That's a 17% annual return, a 380% total return. Let's take a look at their first quarter results. This is their main brands: Waldorf Astoria, Embassy Suites, DoubleTree, Hilton, Hampton, Conrad. That's the founder, Conrad Hilton. In the first quarter, they opened up 106 hotels, nearly 17,000 rooms, resulting in 14,200 net room additions. That means they closed 2,600 rooms. Let's start with their income statement. First quarter of 2022, revenue 2.6 billion, up from 2.3 billion. They operate a franchise model. Nearly 600 million of franchise and licensing fees, 100 million of management fees. They do own and lease some of their hotels, 255 million. Other revenue from managed and franchise properties, 1.5 billion. Total expenses, 2 billion. Operating income, 533 million, up from 500 million. They spent 131 million of interest on their debt, higher than last year of 116 million. Almost 100 million of taxes, so net income of 268 million. EPS 105, up from 77 cents. They're buying back lots of stock, 14 million shares. They had 266 million last year, and now they have 252 million. If all the convertible securities converted to equity, they would have 255 million shares outstanding. Occupancy is only 2/3, 67% of their rooms are occupied. That means about 33% are vacant. Revenue per available room, $104, up 2% from last year. Their highest RevPAR is Middle East and Africa, $142, up 15%. US, $110, that's down 0.4%. That's the only RevPAR that's down. That's pretty surprising. Either they're charging less per room or vacancies went up. RevPAR for Waldorf Astoria, $355. Occupancy is below their average. The hotels they own, RevPAR is higher, $134, compared to their franchises, $104. They have the most hotels in Hampton by Hilton, 3,005. Also the most rooms, 332,000. Their next biggest is Hilton Garden Inn, 150,000 rooms. But those are a lot smaller because in Hilton Hotels and Resorts, less properties but more rooms. Because those resorts are huge. There could be thousands of rooms in just one. You can see most of their properties are franchised, 6,700 franchise properties, over 900,000 rooms. They manage 800 properties, 250,000 rooms, and they only own 51 for 17,000 rooms. Their total system is 7,600 properties with 1.2 million rooms. US properties is the most, 5,600. Next is APAC, 799. Then Europe, 554. The Americas, that includes Canada, 400. Middle East and Africa, 137. Only spent $71 million in CapEx. That's less than half of last year. Last year, $168 million. Their adjusted EBITDA for the quarter is $750 million, up from $641 million. They have higher net income. Net income is $59 million higher. EBITDA, $532 million. EBITDA is earnings before interest, taxes, depreciation, and amortization. But there's something called adjusted EBITDA. They adjust it even more. They add back various things. They add back this loss on debt guarantees. That was $47 million. They had a gain of $7 million from the sale of assets. They probably sold one or two of their hotels. They minus that out. They add back FF&E reserves. That's furniture, fixtures, and equipment. And the biggest add back is other expenses for managed and franchise properties, $109 million. Their adjusted EBITDA margin improved. It was 68%, now it's 70%. The way you calculate that, it's adjusted EBITDA over adjusted revenue. Everything's adjusted with this company. Net income margin, 10.4%. That's up from 9%. They're adding debt. Long-term debt went from $9.2 billion to $10.2 billion. Net debt, which is debt minus cash, $8.8 billion, up about $440 million from last year. For all of 2024, they project net income of $1.75 to $1.78 billion. That's adjusted net income. Adjusted EBITDA projection around $3.4 billion. Let's look at a company on Simply Wall Street. Its last price, $203, $50 billion market cap, down 0.5% in the past week, up 47% in the past year. Let's see what they say about the company. Hilton Worldwide manages, franchises, owns, and leases hotels and resorts. It has two segments, management and franchise, and ownership. They operate Waldorf Astoria, Conrad Hotels and Resorts, Tempo by Hilton. They also operate full-service hotels under the Signia by Hilton, Hilton Hotels and Resorts, and DoubleTree by the Hilton brand. And they have service hotels under the Hilton Garden Inn, Hampton by Hilton. They also have economy hotels under the Spark by Hilton brand, as well as Hilton Grand Vacations. They operate in North America, South America, Central America, including Caribbean nations, Europe, Middle East and Africa, and the Asia Pacific. Founded in 1919, headquartered in McLean, Virginia. Here's their stock price since 2014. They were $66. Their low point was in the beginning of 2016, $52. Then it doubled by 2020 to 104, dropped to about 60 at the COVID bottom, then went from 60 to over 200. Their highest point ever was last month at 212. In March 2024, it went from 214 to 194. Now it's sitting in the low twos, 203. Simply Wall Street's valuation is 174. They say the stock is 17% overvalued. 24 analysts priced this stock at $215. The revenue forecast for 2026 is $13 billion. The free cash flow forecast is $2.3 billion. In mid-2021, their trailing 12-month free cash flow was negative $600 million. Look how volatile their revenue is. It was over $6 billion in 2013, peaked at $7.1 billion in 2015, then fell to $82 million in 2016. That doesn't seem right. got up to $3.6 billion in 2020, down to $1.3 billion from COVID. Now it's at $4.5 billion, a lot lower than 2015. They must have sold part of their business for their revenue to come down so much. Their debt back in 2013 was $15 billion. It's down to $10 billion, but now their equity is negative since their liabilities are higher than their assets. And they don't have that much cash on their balance sheet, $1.3 billion, a lot lower than their debt. Their dividend yield was 1.3% in 2016 and it's just been coming down since then. The forecast is 0.4% by 2026. The CEO's salary in 2017 was $1.2 million. He took a big pay cut in 2020, $350,000. Now it's $1.3 million. He's been CEO a long time, over 16 years. In the past year, only insider selling, no buying. 97% of the companies owned by institutions, 2% by insiders, 2% by the general public. Vanguard is the biggest shareholder, then Capital Research, BlackRock, T. Rowe Price. Bill Ackman's Pershing Square, JP Morgan. The CEO owns 1.4%. The Norwegian bank Norges, 1%. Their employee count was 147,000 in 2013. Now it's 178,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Wiener Börse, Euro TLX, Bulgaria, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.